What is up, Pickled Traders? Lee Ryder here with PrimeIQ Labs, and in this video, we're going to cover Bollinger Bands. We're going to cover how they work, how we use them in our trading, and how you can understand them a little bit better. Let's get to it. Okay, so we're in our charting platform here, so that's Trading View. We're also on the 1-minute chart, which is what we use to trade on. And the important thing to know with the Bollinger Band is that the Bollinger Band is going to be a way to visualize volatility in whatever market you're looking at. But the key thing here is we're looking at a fractal of our current time frame. So let me explain what that means. So you can see this Bollinger Band looks a little different than you might think. And that's because we're actually looking up at the 1-hour time frame to draw this Bollinger Band versus on the 1-minute. If I change it, you'll see it looks very different. So we use a fractal measurement. In this case, I'm using a 1 hour for a 1-minute chart. So this is a 60x fractal. Now we use anywhere from 10 to 100x. That really depends on your market and how that market trades. So that's going to vary, and that will be something that you determine as a trader for whatever your market, because it's going to be different for wheat and soybeans than it is for trading cryptocurrencies. So yeah, just something to note. The important point is that you know that you're looking at a fractal of your current time frame. So we're on the 1-minute, we're looking at the 1-hour Bollinger Band. We use the standard length, which is 20. That's basically a 20-period moving average. And that says that, yeah, this is pretty standard saying this is a look back period. And then the source is the close. We're looking at the closing price. And then standard deviations. Now, I use 2 standard deviations. You could use 3 standard deviations or 1 standard deviation. Now, what a standard deviation says is 1 standard deviation is approximately 70% of all the data in your data set will fit inside 1 standard deviation. 2 standard deviations, that's about 95% of all your data will fit inside there. 3 standard deviations, that's 99%. So I generally use 2 standard deviations. That is also what's standard. And then you'll have pretty much pictured what we have here. And now, why is a Bollinger Band important? Well, it shows us a couple things. It shows us when price is compressing, like for instance, right here, where volatility is getting tight, because generally there's an outsized move following that. And we call that a Bollinger Band squeeze and a breakout. And then once again, we can use our gamma prime dots to time those. But that just lets us know when we're likely to see price compress and then explode out. You know, there's a saying, compressed volatility leads to hyper volatility. The Bollinger Band shows us exactly that. And then because we're on the 1-minute using the 1 hour, the moves are quite dramatic, and that's why we like it. Here you can see a big wide growth. So this is where price breaks above, and then we get a big break to the upside. This is an example where Bollinger Band is showing us where price will likely want to run, because once it breaks above this 2 standard deviations and it keeps going, there's likely something happening in the market that's going to push it much higher because it's changing states, it's changing regimes. And that's really what that's showing us. So this is really how we like to use Bollinger Band. We're using it as a fractal. So like I said, 1-minute charts, but we're using a 1 hour. And then we're looking at where price is relation to where it historically has been. So we like to trade when it's tight in this range. We can trade dot to dot, or when there's a big breakout, we know mean reversion is likely possible. So I hope that was helpful. That's Bollinger Bands. That's how we use it. Check out more videos to learn more how we trade and analyze the markets, and we'll see you in the next one.